Imagine waking up in 2025 and realizing that your savings haven't grown, not because you didn't work hard, but because your money was sitting idle or invested in the wrong places. Every year, millions of people watch their hard-earned money vanish in volatile markets, scams, or poor investment choices. But it doesn't have to be this way. The truth is, in 2025, investing isn't just about luck. It's about strategy, discipline, and understanding the modern financial landscape. The world of investing is constantly evolving. Technology is reshaping markets. AI-driven analytics are influencing stock prices. Interest rates fluctuate unpredictably, and inflation eats away at purchasing power. Yet, amid all this chaos, there are simple, investment-proven strategies that protect your capital while still allowing it to grow. If you want to invest without losing money, you need to approach the game differently than the average person. Most people make three major mistakes. They chase hot stocks, listen to financial experts without understanding risk, and fail to diversify. The result: emotional decisions, panic selling, and sometimes complete financial ruin. But here's the good news: with the right knowledge and approach, you can build wealth steadily, avoid unnecessary risk, investment, and even sleep peacefully at night knowing your money is working for you. This speech will show you exactly how to do that in 2025. You'll learn not just what to invest in, but how to think about investments, how to manage risk, and how to leverage modern tools to make smarter financial decisions. By the end of this, a good investment, you'll understand the difference between reckless gambling in the market and strategic investing that grows wealth safely. Whether you're a beginner with a few $100s or someone with a substantial portfolio, the principles we cover today are universal. They are based on decades of historical data, modern financial theory, and real-world results. You'll walk away knowing how to navigate inflation, interest rate shifts, and market volatility without panicking. So, if you've ever feared losing money in the stock market, real estate, or even digital assets like cryptocurrencies, listen closely. This isn't about getting rich quick, meant. It's about creating a foundation that allows your money to grow safely and consistently. Investing in 2025 doesn't have to be risky if you approach it the right way. And that's exactly what we're going to explore next. Investing without losing money starts with one principle that many people overlook: diversification. Diversification is not just a fancy term. It is the cornerstone of protecting your wealth while still allowing it to grow. At its core, diversification means spreading your money across different types of investments, industries, and even geographic regions. The reason this works is simple. No single investment can predictably deliver consistent returns every year. Markets fluctuate, economies rise and fall, and unforeseen events can wipe out entire sectors overnight. If all your money is in one stock, one sector, or one type of asset, you are gambling, not investing. By diversifying, you reduce the chance that a single negative event will derail your entire financial plan. Consider the stock market as an example. Even if you pick a stock that seems like a sure winner investment, there are countless factors outside your control. Regulatory changes, competition, supply chain issues, or global economic shifts that can cause that stock to drop dramatically. Investment. If that stock represents all of your investments, a single downturn can be catastrophic. But if you have 20 or 30 different stocks across multiple industries, the risk of losing all your money drops significantly. Even if a few stocks underperform, others may outperform, balancing out your overall returns. In other words, diversification doesn't guarantee you'll make money, but it drastically reduces the chance of losing it. Diversification extends beyond just different stocks. It's about incorporating various asset classes into your portfolio. Bonds, for example, tend to be more stable than stocks and can provide steady income. Real estate can offer long-term appreciation and rental income that is less correlated with stock market performance. Exchange-traded funds, ETFs, allow you to invest in a basket of assets, giving you instant diversification without having to pick individual investments yourself. Even within alternative assets like commodities or cryptocurrencies, spreading exposure across different options can reduce volatility. The key is to avoid overconcentration in one area, because no matter how confident you feel, markets can always surprise you. Geographic diversification is equally important. Global events, such as political instability or natural disasters, can affect local markets dramatically. If all your money is invested in one country, you are vulnerable to local economic shifts. By investing across different countries or regions, you minimize the impact of a downturn in any single economy. For example, while the US Market might experience a correction, emerging markets or European stocks might still grow, providing a buffer for your overall portfolio. Technology today makes it easier than ever to access international markets. So geographic diversification is not only possible, but highly recommended for anyone serious about protecting their wealth. Another aspect of diversification is time. Investing consistently over a long period reduces risk through a process known as dollar cost averaging. By spreading your investments over time, you buy into markets at different price points. Investment, which smooths out short-term volatility. This is particularly important in 2025, where markets are expected to experience fluctuations due to technological advancements, inflation trends, and geopolitical uncertainties. Instead of trying to time the market, a strategy that even experts struggle with, you reduce risk simply by investing steadily and diversifying over time. Diversification also protects you psychologically. When you know your investments are spread across different sectors, asset classes, and geographies, it becomes easier to resist panic selling during downturns. Emotional decisions are a major reason investors lose money. Investment, seeing a single stock plummet can trigger fear, leading to rash decisions that lock in losses. But with a diversified portfolio, the impact of any one loss is minimized, allowing you to stay calm and stick to your long-term plan. Finally, diversification encourages discipline. It forces you to evaluate your portfolio regularly, consider different asset classes, investment, and make informed choices rather than following trends blindly. It also pushes you to think beyond short-term gains and focus on long-term wealth accumulation. In 2025, this disciplined approach is more critical than ever, given the rapid pace of technological change, global economic shifts, and market volatility. In summary, diversification is your best defense against losing money. By spreading your investments across multiple stocks, sectors, asset classes, and geographies, you reduce risk, smooth out volatility, and create a more stable path toward long-term wealth. Investment. It's not about avoiding risk entirely. It's about managing it intelligently. A diversified portfolio allows you to sleep at night knowing that even if one part of your investment strategy falters, that the rest of your portfolio can support your financial goals. In an unpredictable world, this is the most reliable way to protect your money while still making it work for you. When it comes to investing in 2025 without losing money, one of the most powerful tools at your disposal is the use of low-cost and passive investment vehicles. Many new and even experienced investors make the mistake of chasing high returns through active trading, attempting to pick the next big stock, or timing the market perfectly. While the allure of rapid gains is tempting, history shows that most people who try to beat the market through frequent trading end up underperforming, and often they lose money. Low-cost passive investments, such as index funds and exchange-traded funds, ETFs, offer a safer, smarter approach that allows your money to grow steadily over time without the stress, risk, and high fees associated with active strategy. The primary advantage of passive investing is that it removes the emotional element from investing. Human psychology is one of the biggest obstacles to financial success. When markets swing, fear and greed often dictate decisions. Investors may panic and sell during downturns or get caught up in hype and overpay for hot stocks. Passive investment strategies, however, follow a set plan, tracking the performance of broad market indices or diversified baskets of assets. By committing to a passive strategy, you are less likely to make impulsive decisions that could jeopardize your portfolio. Over time, investment. This disciplined approach has been proven to generate reliable, long-term returns that often outperform the average active investor. Another key benefit is cost. Many actively managed funds charge significant fees for their services, often including management fees, trading fees, and performance-based costs. These fees can silently erode your returns, sometimes by several percentage points annually. In contrast, passive investment vehicles generally have very low expense ratios because they simply track a pre-defined index rather than paying fund managers to make complex decisions. In 2025, these low-cost investment options are more accessible than ever thanks to fintech platforms and online brokers that allow you to invest with minimal fees and no minimum requirements. By reducing costs, investment, you keep more of your money working for you, which compounds over time into substantially higher wealth. Diversification is also built into passive investing, which is crucial for reducing risk. Whenever you invest in an index fund, you automatically gain exposure to hundreds or even thousands of stocks, bonds, or other assets within the index. This means that even if a few companies or sectors underperform, your overall investment is buffered by the others. ETFs take this a step further by offering the ability to target specific sectors, regions, or asset classes, giving you control while still maintaining diversification. This built-in safety net makes passive investing particularly valuable in 2025, when markets may face volatility due to inflation pressures, interest rate changes, or global economic shifts. Another advantage is simplicity and scalability. Passive investment strategies require far less time and effort than active trading. You don't need to spend hours analyzing companies, studying market trends, or worrying about short-term fluctuations. This simplicity allows you to scale your investments more easily. You can contribute regularly to index funds or ETFs, gradually building wealth through dollar cost averaging investment, which reduces the risk of investing a large sum at the wrong time. Over years and decades, this disciplined approach produces compounding growth that far outweighs the potential gains of short-term speculative trading. Furthermore, passive investing aligns perfectly with long-term financial goals. The goal of investing without losing money is not to get rich overnight. It is to create sustainable wealth that grows steadily while minimizing risk. By committing to low-cost passive vehicles, you harness the natural growth of the market, taking advantage of compounding returns and inflation protection. Over time, even modest contributions can grow into significant wealth, especially when you avoid the common pitfalls of chasing hype or paying high fees. Investment. Finally, passive investing allows you to focus on other aspects of your financial life while your money works for you. Since these investments require minimal maintenance and are designed for long-term growth, you can dedicate time to building skills, advancing your career, or exploring other opportunities without constantly monitoring the market. This combination of safety, efficiency, and reliability makes passive investing one of the most effective strategies for protecting your capital and growing your wealth in 2025. In summary, low-cost passive investment vehicles provide a proven disciplined, investment, an efficient way to invest without losing money. By reducing costs, removing emotional decision-making, building automatic diversification, and allowing for long-term compounding, these strategies minimize risk while maximizing the potential for steady growth. In a world of increasing market volatility and economic uncertainty, adopting a passive investment approach is one of the smartest moves any investor can make. It allows you to harness the power of the market without exposing yourself to unnecessary losses. Making it an essential cornerstone of a safe and successful financial plan. One of the most important principles for investing without losing money in 2025 is protecting your capital through effective risk management. Many investors focus solely on potential returns, chasing the highest gains without giving equal attention to the possibility of losses. The truth is, the higher the potential reward, the higher the risk. And ignoring this fundamental principle is a fast track to losing money. Risk management is not about avoiding risk entirely. That's impossible if you want your money to grow, but it's about controlling it intelligently so that even during market downturns, your financial goals remain intact. Understanding and applying risk management strategies separates successful investors from those who fail. The first step in risk management is understanding your personal risk tolerance. Everyone has a different capacity to handle losses depending on their financial situation, age, goals, and mindset. Some people can stomach short-term market volatility because they have a long-term horizon, while others may panic and make poor decisions when investments temporarily decline. Knowing your risk tolerance allows you to structure a portfolio that balances growth and safety appropriately. In 2025, with volatile markets and rapidly changing economic conditions, this step is more critical than ever. Choosing investments that align with your risk profile ensures that you can stay committed to your strategy during periods of uncertainty rather than making rash decisions that lock in losses. Another essential aspect of risk management is never investing money you cannot afford to lose. This principle might sound obvious, but it is often ignored. Many investors put large portions of their savings into speculative assets, believing they can make a quick gain, only to find themselves exposed to catastrophic losses. In 2025, with emerging technologies, cryptocurrencies, and new market trends, the temptation to chase high returns is strong. Allocating only disposable income, money that won't impact your day-to-day life if lost, protects you from financial stress and allows you to make rational decisions instead of emotional ones. Diversification also plays a key role in managing risk. While diversification is often discussed as a separate strategy in the context of risk management, investment, it is about balancing exposure to different types of assets that behave differently under various economic conditions. Stocks, bonds, real estate, and cash each respond uniquely to changes in interest rates, inflation, and global events. By spreading your investments across these categories, you reduce the likelihood that a single adverse event will significantly damage your overall portfolio. Even within stocks, investment, diversifying across industries, company sizes, and geographic regions further minimizes risk. In 2025, where global interconnectivity means that economic shocks can ripple across markets rapidly, proper diversification is more important than ever. Setting clear rules for when to sell or reduce exposure is another critical risk management strategy. Stop loss orders, for example, automatically trigger a sale if an investment falls below a certain price, preventing small losses from turning into larger ones. While these tools should not replace careful planning and analysis, they serve as a safety net that enforces discipline. In fast-moving markets, having predetermined exit strategies ensures that you respond rationally rather than emotionally. Maintaining an emergency fund is also a vital component of protecting your capital. Unexpected expenses, job loss, or personal emergencies can force you to sell investments at the worst possible time if you lack liquid cash. By keeping 3 to 6 months of living expenses in a safe, easily accessible account, you give your investments the time they need to recover from market fluctuations. This buffer is a critical layer of protection that reduces the pressure to make poor decisions during downturns. Another overlooked aspect of risk management is avoiding excessive leverage. Borrowing money to invest magnifies gains, but it also magnifies losses. In highly volatile markets, leveraging can quickly turn small dips into devastating losses. Investors in 2025 should be particularly cautious with leverage, as market swings are expected to be more frequent due to technological shifts, interest rate changes, and global economic uncertainty. Conservative use of leverage, or avoiding it altogether, is one of the simplest ways to protect your capital. Finally, risk management requires continuous monitoring and adaptation. Markets evolve, economic conditions change, and personal circumstances shift over time. A portfolio that is safe today might become riskier tomorrow if your goals, time horizon, or the economic environment changes. Reviewing your investments regularly, rebalancing your portfolio, and adjusting strategies in response to new information ensures that you remain protected even as conditions shift. This proactive approach allows you to identify potential threats early and make adjustments before losses accumulate. In summary, protecting your capital through risk management is essential for investing without losing money. By understanding your risk tolerance, investing only what you can afford to lose, diversifying effectively, setting clear exit strategies, maintaining an emergency fund, avoiding excessive leverage, and continuously monitoring your portfolio, you create a robust framework that safeguards your financial goals. Risk management is not about avoiding opportunity. It is about controlling exposure so that your investments can grow steadily and safely in the unpredictable markets of 2025. It is the foundation upon which every successful investment strategy is built, allowing you to pursue growth without jeopardizing your financial security. One of the most crucial elements of investing without losing money in 2025 is the commitment to continuous learning and adaptation. The investment landscape is changing faster than ever before, driven by technological advancements, globalization, and evolving market dynamics. Ignoring these changes or relying solely on outdated strategies can put your capital at risk. Investors who stay informed, adapt their strategies to current trends, and understand emerging opportunities are far more likely to grow wealth safely. Continuous learning is not just an optional advantage. It is a necessity for anyone who wants to invest intelligently and minimize risk. And the first step in continuous learning is understanding that markets are complex systems influenced by countless factors. Political developments, economic policies, interest rates, inflation, technological breakthroughs, and global trade can all impact your investments. For example, a sudden change in government policy or a new regulation affecting a major industry can send stocks tumbling or boost certain sectors unexpectedly. In 2025, rapid developments in areas like artificial intelligence, renewable energy, and blockchain technology can create both opportunities and risks. Investors who take the time to study these trends can position themselves advantageously, while those who ignore them may find themselves exposed to unexpected losses. Staying informed also involves regularly consuming credible financial news and research. This means going beyond sensational headlines and understanding the underlying data, reading quarterly earnings reports, analyzing economic indicators, and following professional analyses can provide a clearer picture of market trends and potential risks. In the age of information, knowledge is a powerful form of protection. By dedicating time to learning, you reduce uncertainty and make informed decisions rather than reacting impulsively to fear or hype. Adaptation is equally important. Even the most disciplined investor can encounter situations where old strategies no longer work. Markets evolve, asset correlations change, and what performed well in the past may underperform in the future. For example, certain sectors that dominated returns in the previous decade might face stagnation, while emerging sectors could provide new growth opportunities. In 2025, investors need to be flexible, willing to adjust allocations, and adopt new tools and approaches to maintain a competitive edge. This doesn't mean abandoning your overall strategy, but rather tuning it based on current information to reduce risk and optimize returns. Investment. Another key aspect of learning and adaptation is understanding new investment vehicles and technologies. Exchange, traded funds, index funds, digital brokers, robo-advisors, and blockchain-based assets are reshaping the way people invest. While some of these innovations offer substantial potential, they also carry unique risks. Educating yourself on how these tools work, their benefits, investment, and their limitations allows you to use them safely. For instance, while cryptocurrencies and decentralized finance can provide high returns, they are extremely volatile. Investment. Learning how to approach these assets prudently, allocating only a small, manageable portion of your portfolio, protects your capital while still giving you exposure to innovation. And continuous learning also encourages critical thinking and skepticism. Not every opportunity or trend is worth pursuing. In 2025, the market will inevitably be flooded with investment fads, social media hype events, and misinformation. Investors who educate themselves can separate genuine opportunities from noise. They can analyze fundamentals, assess risks, and avoid being swayed by short-term excitement. This disciplined approach reduces the likelihood of making costly mistakes and losing money due to impulsive decisions. An often overlooked part of adaptation is learning from your own experiences. Every investor makes mistakes, but the key is to analyze them, understand why they occurred, and adjust strategies accordingly. Journaling investment decisions, tracking performance, and reviewing outcomes helps identify patterns and improve future decision-making. In a rapidly changing market, this reflective process is invaluable because it allows you to evolve continuously and protect your portfolio from repeating errors. Finally, continuous learning fosters confidence. Investing can be intimidating, especially during periods of volatility. The more knowledge and understanding you acquire, the more confident you become in your decisions. Confidence reduces emotional reactions and panic selling, investment, which are major causes of losses. In 2025, where market swings are expected to be frequent due to economic and technological shifts, this mental fortitude is a critical component of risk management. In summary, investment. Committing to continuous learning and adaptation is essential for investing without losing money. By staying informed about market trends, analyzing credible data, understanding new investment vehicles, critically evaluating opportunities, learning from mistakes, and adapting strategies to evolving conditions, you can protect your capital while positioning yourself for long-term growth. Knowledge equips you to make rational decisions, anticipate risks, and respond effectively to change. In an increasingly complex and fast-paced financial environment, continuous learning is not just a strategy. It is a safeguard that allows you to navigate uncertainty, seize opportunities, and grow wealth safely in 2025 and beyond.